preparing to stream. Yep. There you go. And we should be live.
So you got it?
Yeah, should all be live now. Just
If it hasn't hit,
YJP is now live.
yeah. Okay, do you want to let everyone in and then we'll start?
Yeah. I'll let in, I'll deactivate the waiting room.
Yeah.
All right.
Okay, hello everyone and welcome. This is exciting to be back for another workshop, and we'll just wait for everybody to get on and then we'll start.
Pardon me.
Hey, Valerian.
Hello, Moishi.
Hi. Okay, we'll get going. So welcome to everyone who has joined us for this wonderful workshop, both on social media. I'm looking at two cameras over here. On Facebook, welcome, and on our Zoom meeting, welcome. It's wonderful to have you here. And I want to begin by thanking Farrell, my very dear friend, Farrell Meltzer, who I just sort of threw an idea to Farrell and said, why don't we do it? And he goes, yep. And he was good enough to not just say yep, but actually pull together an incredible panel of speakers and facilitate the time, organize it, and really, really appreciate it, Farrell. And I really want to thank you on behalf of YJP. Farrell's been we actually had a workshop in Farrell's office probably by now 3 years ago, which was a beautiful workshop in the office. Some of you would remember. And now we're back here virtual, but hopefully we are moving to live. And I just want to, by way of introduction, tell you we've got events coming up this week for Hanukkah. We've got incredible Hanukkah parties, 2 events. We've got a Friday night social event this Friday night live in person. So we look forward to welcoming you and seeing you all, but one of the things I wanted to share just by way of introduction tonight is it's been billed, shifting sands, and we're living in a time where things are forever evolving and things are forever changing. And it just dawned on me that the next Jewish festival coming up this Sunday night is Hanukkah, known as the Festival of Lights. And one of the beautiful traditions is that the first night we start with 1 candle. Second night, we evolve and we grow as human beings. So we bring more light and we light 2 candles. And then thereafter, the third night, you've got it, we light 3 candles. And you go all the way till 8 candles. And I thought it's quite appropriate for the topic of tonight, because we always have to evolve and grow. And no matter what happens in life, no matter what the shifting sands, if you like, no matter which way the sands are blowing and the winds are blowing, you've always got to make sure that as a human being, every day you're 1 step better, you're 1 step advanced than you were yesterday. So I thought it's beautiful, and it aligns with the Festival of Hanukkah, which is all about bringing light and warmth. So YJP is all about bringing light and warmth, and it's beautiful to have you all, and thank you. With that, I'm going to pass on to Farrell, who's going to introduce our wonderful panelists, Anita, Tracy, and Scott, who I've only just met virtually, but thank you all for joining us. And Farrell will give them the appropriate and due intro that they warrant and deserve. Thank you. Farrell, on to you.
Thank you very much, Rav Moishi. It's a great pleasure to be here. Thanks for inviting us to do it, and welcome to everyone. It's true what the rabbi said when he asked me to do it. I agreed, but as most of you would know, I try and avoid public or semi-public appearances. So this is not something I generally do, but there are 3 reasons I agreed to do it. The first is that, and most of you on this call will know, when Rabbi Moishi asks you to do something, it's just impossible to say no. And the reason it's impossible to say no is because he never says no. You can call him in the middle of the night, literally, and ask him anything. He'll get out of bed and go and do it for you. And that is true. That's not an exaggeration. So how can one say no to him? That's the first reason. The second reason is that YJP is a wonderful organization and close to my heart. I was once a YJ peer, and I know what it's like to be in that phase of life and phase of career. And I have spoken with YJP a few times over the years, and I've always enjoyed it. I've always, as they say, by giving, you get much more than by receiving. And so it's a delight to be able to bring together this group of people and share with you some of our thoughts. And that is the third reason. It's I saw it as a great opportunity to bring together a very special group. I said to the rabbi, as long as I can choose the panel, I'm happy to do it. And you know, to bring together people from different backgrounds, different walks of life, careers, which I think are a group that many of you will not have had exposure to in the past, and who I know will be, you know, hugely valuable to listen to and talk with today. So here we are. I decided, instead of you know, long bio introductions, you can all go online and read the very impressive bios of Anita, Tracy, and Scott. I thought I'd, you know, given that we're young professionals here, I'd ask them each to give me a tweet describing themselves. So a tweet of their bio, just a few words. And Anita, her 7-word bio was makes every day and every interaction count. So I should tell you, as I read these, I sat back and reflected, and I thought, by the end of these 3 tweets, you could almost stop the call, because if you just take them away, write them down, reflect on them, and reflect on them again, you'll see that they're so full of insight and wisdom. And there's just so much, as young professionals, you guys are able to learn from these few powerful words. So Anita's was makes every day and every interaction count. In brackets, tries. So that's an indication of her humility. Scott's tweet was focused on the medium and long term to make the right decisions today. Again, if you think about that, making decisions today, but with a perspective of the long term. And we all know that in Pirkei Avot, the ethics of the fathers, it says a wise man is a person whose eyes are in his head. And the commentaries say, what does it mean his eyes are in his head? It means he can see the effect of his decisions now into the future. So that was Scott's tweet. And Tracy's tweet was also fascinating, and hers was obsessed with data. Obsessed with data. And again, a huge amount of wisdom. There's a lot of debate in the psychological literature about the importance of intuition versus data, and intuition versus more analytical decision making. And both are important, both are vitally important, but data, making decisions based on good, solid data, certainly is one of the most fundamental and important factors in life and in business. So Tracy's was obsessed with data. So just a few further words before I jump into some questions. So just paraphrasing some things out of the bio. So what Anita's bio basically says that as you unpeel the various layers of successful, powerful organizations, you unpeel the brand, the products, the services, the technology, what you get to at the core is people. That's the opening paragraph of Anita's bio. And she then goes on to explain how her whole career has been in people. She was the CEO of Slade, which is, I believe, a 40-year-old recruitment, headhunting people, consulting firm. I know them well. I've dealt with them, a fantastic organization. Anita ran that, and I think is very well equipped to share with us, particularly with this group, the qualities that make an outstanding professional and make for an outstanding career. And Anita also has a long list of amazing not-for-profit community roles that she has been involved in, is involved in, not least of which is Blue Sky, which is a mental health organization, which obviously we all know is so important at the moment. Scott Keck is really quite a towering figure in the world of property in Melbourne and in Australia. Scott's been, I know he doesn't look this old, but he's been in business in Melbourne for 53 years. He founded, he was one of the founders of Charter Keck Kramer, which is the leading, one of the leading, I think it is the leading Melbourne-based property advisory firm that bears his name, and I think, and he's executive chairman. He's been doing that for 50 years, and sits on various boards, advisory boards. One of those boards actually is Wingate's Direct Property Investment Board, which Scott chairs. And I can tell you he's sought after by everyone for his advice on property. And Tracy's been in the financial markets since 1995, so a very long time. She has worked as an economist at Credit Suisse First Boston, back when Credit Suisse was First Boston, was part of First Boston, or by First Boston, part of Credit Suisse. She's worked as a fixed income fund manager in Edinburgh, has been involved through the global financial crisis in money management and fixed income, which will be fascinating, hopefully, to hear a little bit about. She was the head investment strategist at UBS in UBS Asset Management, and she's now the chief investment officer at a firm called Escala, which is a really elite private wealth advisory firm. I can tell you from firsthand experience, I'm personally a client of Escala. Not sure if my advisor is on the line, Travis Pitt, but if he is, I highly recommend him. He's an outstanding advisor. There are many outstanding advisors, but he's certainly one. And Escala is a really outstanding firm. So to have Tracy with us today is really something special. She has an incredibly clear and incisive way of looking at the markets and the economy, and we're going to hear a little bit about that later today. So I'm going to jump straight in and start with you, Anita. Let's start with the question of people. The question that I want to ask you is high performers. We've got all these people listening to us. Many are high performers. They all want to be high performers in their lives and in their careers. What are the attributes as a headhunter, as an advisor to employers and employees? What do you look for?
Farrell, it's a great question. And I must say, I didn't create the list, but I pressure tested this idea of the capabilities and qualities of high performers over the last 15 years, and they never failed to be proven to me. It was work done by Jim Collins 20 years ago, and interviewing and profiling high performers, whether you're a bartender, a barista, a barrister, or the boss of the ANZ Bank. What these high performers have in common is that they have a passion for what they do, and they share values with their organisation. And so one of the passion for what you do, sometimes you have it, sometimes you don't, but sometimes you can make that passion if you can find the purpose. But sharing the values with your organisation is really important. And I think if you find yourself in a mismatch, it's going to be tough. So they're the two sort of variables, because you won't always have a passion for what you do or find yourself sharing the values. But then there's some immutable facts that you carry with you. And I can't see all the people on this call, but I reckon you're all super bright and capable people. What you bring to the table will be the fact that you're reliable. So that reliability piece means that you do as you say. And perhaps, Scott, you've seen people who you have to double check, have you done it? Well, good people don't have to be double checked on. They've done it because they've said they'll do it. They have responsibilities, not a job. Nobody ever said that's not my job. They have what we call a window mirror approach, and that's that EQ piece. So when things go well, they look out of the window and they go, who else helped me succeed in that? And when things go badly, they don't look out the window first. They look in the mirror and say, what part did I have to do with that? So they're self-reflective, and they don't play the blame game. And the other piece is they don't need to be managed. They need to be inspired, motivated, and led. And so through all my career, the people I've worked with or reported to or had reporting to me, those high performers all have those qualities.
Fantastic. I hope someone, maybe Brian's written all those down, and we can have the YJP team email them out to the members, because they should be printed out and stuck up on all of our notice boards. That's great, Anita. Just a second question related before we move on to Scott. I said this the other day on a different podcast that we were on with a different group. You know, when I grew up in South Africa, I don't know if you guys know, when Henry Ford invented the car and started producing Fords, they used to say you can have a Ford in any color as long as it's black. And when I grew up in South Africa, my mother said to me, you can do anything you want to do. Anything you want to do in your career, as long as it's a doctor, lawyer, or accountant. So I chose accountant. I think that's changed. I think it's changed a lot. Are you seeing in your work any, what would you say to our guests here today are the key areas, or are there key areas that one should follow from a career? What are the doctors, lawyers, and accountants of today?
It's a really good question, Farrell, and I don't know what the makeup of this group is, but certainly that's been freed up, and I don't know how many of your parents have really put pressure on you to be the doctor, lawyer, accountant. Just as an anecdote, I was introduced to a very bright Vietnamese Australian who was on his way up in one of the big firms, but he wanted to change. And I haven't heard this ever like this. And I gave him some ideas about other organizations that were more in the startup space and not the established blue chip tier 1 firms. And his ears pricked up, but then he sat back and he said, no, you don't understand, Anita. I could never do that. I'm number one son. So for him, this responsibility to carry the honor of his family by working with a major brand was just part and parcel of who he was. Now, I didn't grow up with that, and I certainly haven't instilled that on my children, because also in our business, we see often, and I'll just say this broadly speaking, often men in their 40s and 50s who have probably been led down a particular path through influence of parents or peer groups, but really their heart's not in it. And they find themselves in middle age stuck. And I think that's the saddest thing, because they've, worked with their families, done the right thing, but they've never found where their heart is. So I would just urge people to, you've got to, buy your house and cover your mortgage and, do all that. But don't be trapped. We've only got one life. Don't be trapped in something that doesn't really make your heart sing in the morning. So that's
fantastic. You've reminded me of, I don't remember who said it, someone great said, when asked this question, said, I've never worked a day in my life because my work, you may remember, I don't know who that was, but I've never worked a day in my life because my work's not work. It's my hobby. It's my joy. It's my...
Oh, that must have been me, Farrell, that said that.
That's right, Scotty. That was you. Now I'm pleased you reminded me that you're there, because we're going to turn to you now. We'll sort of rotate through and come back. We'll come back to some of these themes with you, Anita, later. But Scott, property. I've got a question for you, which we'll start with, and you can take it anywhere you want. But
sure.
We all know one good investment strategy, and I've got a feeling Tracy will disagree with this, but one good investment strategy is just look at what smart people are doing and follow them. Sometimes it works, sometimes it doesn't. My question to you, Scott, is I know you advise a lot of the smart people, a lot of the big private families, big institutions. What are people buying? Where's the smart money going, and who's buying and who's selling? And what are they buying and what are they selling?
Well, that's a good question, Farrell, and good evening, everybody. The answer to this will actually cover a few interesting points. And we'll start with the Jewish parents who wanted their son to be a doctor or a lawyer or an accountant. Let me explain why. One of the main reasons for the sale of substantial commercial assets in Australia at the moment, and there are always exceptions, but one of the main drivers is generational. If you imagine at the end of the Second World War, a young 20-year-old man returns home in the post-war economic boom of Australia through to the current time, a lot of wealth's been created. A lot of that wealth is now owned by matriarchs and patriarchs who are in their 80s and in their 90s. And that family, let's just take one family, that family pursued that investment ethos and that asset process. And most of those families had children who are sort of my age, and generally those kids were accountants or lawyers or from the commercial areas or background other than for doctors. Why are these older people selling now? Well, there's two reasons. The younger people in the families aren't necessarily from commercial backgrounds because they've had a wider and more liberal education and life experience choice. And rather than being, necessarily commercially equipped, they might be artists or musicians or basket weavers in Turkey or anything you'll care to imagine. But life's been a lot wider, a lot more enjoyable, and so we don't have this necessarily this deep-seated family commercial intellect. And one of the other reasons is that there are so many beneficiaries in estates now that large assets can be a problem, and a lot of patriarchs and matriarchs are making the wise decision perhaps to sell a $20 million property and pull it into smaller lumps somewhere so that it's not a legacy that's left that the younger generations have to deal with as a single asset. I'm sure everybody listening to me would understand what I mean by that. So it's actually the coincidence of demographic age and so on in Australia, the prosperity that's been enjoyed, the creation of this wealth. There's never really been in the history of Australia before such a large group of people at an older age, relatively so wealthy, who now have to think how they're going to dice and splice this up for their estates. And they're making that move proactively rather than leaving it as an area of possible dispute and generational anxiety. And actually at the moment they're very happy to sell because interest rates are low, yields are low, values have gone up. It all seems to have come at a great time. And on the buy side, if logically those people are not buying but they're selling, who is buying? For commercial assets generally, whether they're retail, industrial or whatever, there are a group of commercial purchasers from small syndicates to large funds, and they know that they are buying at a time of high values and low yields. So how do they justify that to their investors? And the way that they do that is logical and it's reasonable, because yield alone isn't the only reason why responsible fund managers buy property. They have to buy cyclically for a number of other reasons. A very significant one is diversification. Another one is over time, they like to replace old assets with newer assets physically so that they're not vulnerable to physical obsolescence over time. Another reason is that they like to trade in smaller leases for longer leases. And whatever, we just had a little, you still got me okay, Farrell? Yeah.
Someone, if everyone could just mute their mic, please. Thanks.
There we go. And I was going to say the other reason is that in these very large funds, and let's say a large fund is currently distributing a 6% yield to its investors, if they buy with good justification some properties and pay a premium for them at lower yields, those lower yields won't really dilute the distribution very significantly in a large fund anyway. So the market generally, as I say, there are always exceptions, but the market generally now is made up on the sell side by private wealthy families responding to generational needs, and on the buy side by institutions motivated by a number of reasons. And I see these conditions probably lasting at this type of strength for another 18 months to 2 years. Before what is already looming as a gradual increase in interest rates starts to have the impact of slowing down the rate of value growth in some of these assets. But there'll be plenty of time for all the players to adapt.
Scott, that covers a huge range of interesting demographic, family, property factors. Question, to me, it feels like with interest rates so low and yields so low, therefore values seem very high. Is there any way that one can buy a property now at such low yields, especially industrial, which is trading at incredibly low yields, and not lose money?
Oh yes, look, I think so. Certainly, you can confidently go into the market and buy properties at values that will stabilise at their capital value and still throw you off a good yield. And so they mightn't have the traditional robust internal rate of return, which is capital growth and yield, but they'll still be good on the yield side. The only properties that will probably slow in capital growth and could be at very remote risk of some downturn in a higher interest rate environment would be the ones that were so passive that they had no opportunity to add value through further investment, refurbishment, rejigging of the rents and one thing and another, you know. Most properties are very forgiving over time, and you can always find ways to give them a shake and get them to be more productive again. But if you're a lazy landlord and you buy one that's too fat to start with, well, you'll probably labour under your own poor choice.
So I'm going to guess that I'm going to answer my own question now. It seems like we've had this multi-decade, you know, the way to make money in Australia, buy property. You know, those people who came here after the war started accumulating.
Yeah.
We all know that story. And the question I ask myself, is that cycle now ended? Or is it still time to make, is there still time to make money in property over the next 20 or 30 years?
Well, look, a short answer to that. The reason that so much money was made was because Australia was growing. And when an economy is growing and the population growth is growing, that's a fundamental environment in which real estate responds. For example, real estate always grows ahead of inflation whenever you have inflation. So if I don't get an opportunity to say anything else tonight, let me just say two things now before I forget them. Australia's responsibility, financial responsibility to its older generations and so on, means that for the future of Australia, we have to grow. We have to grow our productivity. We have to have wage growth. We need to have a certain level of inflation. To do that, we need to have a lot more population. And most of that population is going to come from immigration. And most of the immigration into the future is going to come from the broader Asian region, including China and India. So two key points here. Australia will grow. By the end of this century, it'll probably be 50 million people, if not more. That means that there is assured fundamental opportunity for worthwhile real estate investment and development in a wide range of sectors. But looking ahead to what sort of country we're going to be in, and particularly ethnicity, let me say this. Just over 20% of Australians describe themselves in the current time as being of either Asian or Indian ethnicity. As that group with its birth rate grows, even if there were no more immigration, they would become relatively bigger in Australia as the currently predominant Caucasian cohort died off a little. When you then add in the immigration equation, which is going to be mainly influenced by immigrants from Asia and India, it means that by the end of this century, absolutely guaranteed, more than half of all Australians will claim first, second or third generation Asian or Indian ethnicity, and it's more likely to be about 65%. So if you want to make the right decisions today and understand where Australia is going, just be acknowledging and accepting and looking forward to the fact that 80 years from now, we're going to be a full-blown, full steam Asian country, taking up our rightful position in this part of the world, with all of the influences that come from that. Mega cities in Sydney and Melbourne, much more dense. Towns that we call regional now will be cities, and it'll be a completely different ball game. And for those of us that like real estate, it's a wonderful opportunity.
That's a fantastic and amazing opportunity to look forward to.
Yes.
So you've mentioned inflation. I'm going to turn to Tracy. Now, Tracy and I have been slightly at different ends of the spectrum on the inflation question recently. I've been a believer, well, maybe not, but I've been a believer for quite a while that inflation, I spoke publicly in August 2020 that inflation was coming before it was popular and sexy to talk about inflation. It's now here. The real question is, for how long is it here? Is it transitory? Are we seeing a spike due to all the dynamics going on in the supply chain and other related things, or is it here to stay? And second question is, and I know the answer, I won't steal your thunder. I know your answer, Tracy. I won't tell you my answer, but usually if my view is different to Tracy's, it means I'm wrong. And the second question is, based on whatever your answer to that is, Tracy, what does that mean?
Well, thank you, Farrell. And I wouldn't completely agree with you that if my answer is different to yours, that means you're wrong. That's not true. So I think the inflation issue, is it transitory, is it permanent? This is the great debate right now. This is the one thing, the top of minds of every single investor in the world right now, because inflation, knowing if it is transitory or permanent, then will dictate whether central banks will begin to raise interest rates, how quickly they'll do that, how soon they'll do that. And then that, of course, as Scott said, affects your discount rates and the attractiveness of assets. So it is the key to really try and understand and get right at the moment. The transitory camp are those analysts that think, well, you know, we have had an event. We had a major event in the form of the pandemic. And I should emphasize, it was an event. There was nothing more, it was an event. And in response to that event, we had the biggest stimulus from governments we've ever seen. The biggest stimulus came from the US government, and actually their fiscal spending was bigger than anything in their own history. And what that did was it worked, you know, by putting money into the pockets of households and consumers. We did what we would do, and that is to spend it. But because we've spent most of the last, or a lot of the last 18 months or so in lockdown, we couldn't do what we'd normally do, which is spend half of it on services and half of it on goods. What we did do is spend just about all of it on goods. And so that's then created the secondary side effects there, that particularly when you consider that 90% of the goods that we consume travel over the sea. And so that's had the obvious consequences that we don't have enough ships, we don't have enough crates, and we don't have enough port capacity to deal with all of these things that we're buying. We're all buying goods at the moment, and particularly, you know, we've been operating in a world now for the last 20 years or so of just-in-time inventory management. So, you know, there aren't a lot of warehouses around. There are now, but there weren't a lot of warehouses around stocked with goods. It was a just-in-time inventory system. And so I guess it's no surprise that you have this, you know, record-beating stimulus package that has fallen into our pockets, and we've done as we should and go and spend it, that all of a sudden there's blockages in the supply chain. And, you know, you have situations where now there's 72 ships sitting off the port of Los Angeles and Long Beach in the US, etc. So the transitory camp believe that bulge, if you like, will pass through the system. Once we spend all of our spending, we'll go back to normal because we've run out of money to spend, and this blockage will clear. The permanent inflation camp are of the view that there will be scars. There will be inflation scars that will be left over from this. And that really is coming from the fact that this blockage in supply chains has now lasted so long that it's starting to affect our psyche. We're now feeling like inflation expectations are going to stay for a long time. And so what do I do if I know that the price of a carton of milk is going to go up next week? Well, I'm going to ask my employer for a higher salary. And so the concern is that this will then feed into higher wages growth. And because that's a cost on business, then businesses will then pass that higher cost on in the form of higher wages, and that's how you get this, what they call a wage price spiral. Now, to your second question there, Farrell, I am in the camp that that inflation will ease next year. I think it will end up being at a level that's above where we were prior to the pandemic, but it will certainly come down. And part of that is because we're actually not seeing a lot of the wage growth that is of great concern. We are seeing it in the US, but mainly for younger people. We're really not seeing it in Australia at the moment. You know, wages in Australia are close to record lows. So it's, and part of that is due to the way that our wages system is negotiated. We used to say, when I was an economist, we used to say it's a third, a third, a third. A third of the labour force negotiates their wages through the centralised system. A third negotiate through enterprise bargains, and a third are individual contracts. And all of these are fairly long-term contracts. And so wages, it takes a long time for wages to adjust. And my view is that by the time we need to think about that the wages pressure will significantly come back. And we're already starting to see it in a lot of the commodity prices. For example, they shot straight up. The price of lumber went up quite significantly, and it's come down just as quickly. It's quite a bizarre environment that we have been witness to in the last 18 months, and it will be studied for years to come because it was absolutely fascinating. I think you might be on mute there, Farrell.
Sorry. So if inflation does moderate, but it's still higher than it's been in the past, what does it mean? One of the things being talked about, you know, if interest rates go up, how much will they go up? You know, can the central banks afford to allow interest rates to go up, given that, you know, the central banks are the biggest holders of government debt, But if interest rates do go up, what happens to asset prices like equities? So, you know, I'm sure most people on this call would hold some equities, shares in their super fund or be traders, and, you know, there is a big camp that's saying things are crazy out there, a crash is coming, or at least a significant adjustment is coming. You know, there is a bit of that feeling of .com bubble in the air. There are companies trading at 200 times earnings, or the earnings that barely exist, 200 times multiples of revenue. It's happening out there. What's your view on that? Are we to expect a correction? And if so, how does one position one's investment thinking?
Well, I think we should expect a correction, because that's part of the normal operation of the market. You know, this is not a free ride. We're in there to get a return. In order to get that return, we take risk, and so markets don't always travel in a straight line. They will go up, and they will have periods of correction. So we are fully expecting a correction, but it's, you know, at this stage, we don't think it's going to be a significant correction like it was in the tech bubble, or, for example, like it was during the GFC. It's just too early in the cycle for that to happen. And when I was a young economist, my boss used to say that markets don't die of old age. You know, something has to come along to kill it off. And with equity markets, what does that is central banks tightening interest rates too much. Not central banks tightening interest rates, but central banks tightening too much. And we saw that if we go back to the last interest rate cycle, for example, in the US, the interest rate started at where we are currently, actually at 0.25%. They tightened interest rates all the way up to 2.5%. Now, it was over a period of 3 years, but that was 9 interest rate hikes. It was too much. It was 1 or 2 rate hikes too much. And that's when we saw a big correction at Christmas in 2018. So that's the thing to be watchful of. I think the Federal Reserve will start to raise interest rates next year. They'll do that before Australia does. But I think it's still supportive for equity markets, and we're still a long way from the point where they tighten too much. You know, I think we're a long way from that yet. In Australia, it's a slightly different case.
We're going to come back to that. And in a few minutes, I'm going to come back to you, Scott, and talk about residential property prices, which are, I think, probably very sensitive to this interest rate question. But let's go back to Anita for a moment. Anita, back to real life, day-to-day things for our audience. What advice have you got for, I don't know what the average age of the group is, maybe 30? What advice have you got for these young professionals at the early stage of their career?
Farrell, firstly, Tracy, it's interesting to hear from you because the award rates and the enterprise agreements, I'm sure, are pretty stagnant. But anybody in the professional classes, the salary increases are phenomenal right now. We are seeing counter offers. We are seeing people leave jobs at $180 for another $70,000. Counter offer $20,000 to stay. There's a really interesting conundrum at the moment with skills shortages. So just thought I'd mention that because it does kind of tie into what I might answer your question with, Farrell, and that is you 30-year-olds, you plus and minuses, all you bright young things, it's your market right now. But to make it your market, you're going to have to work really hard. And I think sometimes organisations aren't quick enough and bright enough for you, but a little bit of patience is really worthwhile. Whether you're in a big corporate enterprise, multinational, or a national organisation, or whether you're in a startup, nothing takes the place of hard work. So you've got the smarts, but it's not enough. So that conscientiousness, you know, that doing as you'll say you do and delivering, going the extra mile, maybe working the extra half hour to finish off a job so you can start the next morning with a fresh sheet of paper with a fresh task. It all adds up to being a really great employee, and you'll shine. And there's no magic formula about that. The other piece that I think is worth mentioning is that you've all been brought up almost as digital natives, I would suggest. And so your default, you're probably spending 8 hours a day on your mobile phones and texting and emailing. I'd really urge you in the workplace, whether you're working from home or in the office, is pick up the phone whenever you can and go and have face-to-face meetings. It's really important for relationship building. I don't know what your experience is or what you think about that, but even amongst your own age group, we always say emails and texts get stuff done, but they don't build relationships. And so as you build your career, your relationships and your networks are going to be really critical. I don't know if that makes sense to you or whether that seems so simple, but I think it does make a difference.
Yeah, that's great. I'd like to extend the question as a reflection of my own experience. I was very impatient at that age and made a lot of mistakes as a result. I've often looked back and thought, gosh, I shouldn't have jumped at that point. Of course, in the long run, you look back and everything's meant to be and it all happens the way it's meant to happen. You wouldn't be where you are today if you hadn't done all those stupid things back then. But I think I could have avoided some pain if I had a mentor like you back then, Anita. But my question is, what's the right balance between impatience, drive, pushing through, and just hanging in there and breaking through where you are?
It's a really good question, Farrell, and I'd probably have to almost have a face-to-face conversation with every person individually, because it depends what the blocker is, whether it's just impatience and you can see how fast it can work, or whether you can just sit tight and go along with it for a bit longer. I think my view, and I'll just talk about that age when you finish university to say when you're 30. I don't mind seeing CVs with 2 or 3 different roles in that time, because there is an impatience, and often the kids are smarter than the bosses, but that's only part of it. And so you will impatiently move on to the next thing because things aren't moving quickly enough. And so it's great to try things. But I would hope by the time you're 30, you've worked with a really good manager and a really good leader, because you'll learn so much from that person. So as you're going, if you personally in the audience today are feeling like things aren't going fast enough for you at work, when you are ready to make that move, do your due diligence, because don't just jump from one job to another without doing that due diligence. Make sure the person you go and work with next is a really great leader who can inspire and motivate and develop you, because that's one of the biggest kickers you can have for your career. So don't be scared to do your own due diligence. You think, oh, thank you very much for the job. But in fact, they know that they've got talent, and they need to also make sure that they're going to support your development in the way that you need it. So I don't have answer to patients, but I understand it really well.
I'd like to add one thing to that before I come back to you, Scott, and that is, as an employer of many young bankers and professionals and analysts and lawyers and all sorts, I would say, if you're feeling in your career or in your job that things are getting a bit stale, or you feel like you can do more, rather than make the mistake that I made back then, which is go and look for another job, go and tell the company you work for, go and tell the person you work for, tell them you want more, tell them you want more challenge. And because very often we make this mistake every day. We look at our 35-year-olds and say, oh, they're young fellows, and then you look around and all your senior people are 52, and really the 52-year-olds should get out of the way and we should promote all the 35s, but you forget about that. So sometimes it requires you as young professionals to come forward, grab that ball and run yourself. Take John McFarlane, who was my boss way back in ANZ, used to say, you've got to take responsibility for your own career. But start at home, just like charity starts at home. Start looking in your own backyard before you look to jump. Would you agree with that?
Absolutely. Put your hand up, absolutely, and let them know, because you sometimes think, oh, I'm doing a really good job, I'm delivering, and you're expecting the tap on the shoulder and going, come on, Anita, next job for you. It doesn't happen like that. Because if you're doing a great job and being paid at a level, that suits them too. So put your hand up. It's great advice, Farrell. Yeah.
Scott, we're going to talk now. I know you've got things to say about that, because you've employed more young professionals in your 53 years than probably all 3 of us put together double. But I want to just take you to residential property for a minute. I've got young teenage and early grown-up children. I know what it's like to buy houses. And I know what it's like for young people to be able to afford to buy a home in the areas that most want to live in almost any area, really. I don't know how most people do it. I just don't know how they do it. If they don't have help in some way, or have a really high earning job that allows them to pay a very big mortgage, I don't know how they do it. Is it sustainable? What's going on with this residential property thing? And what's your advice to these guys? Do they get into the market? Do they wait for a correction?
Well, Farrell, let me say this as an introduction. Whether we're talking about a younger first home buyer, whether we're talking about a bigger budget and a second home buyer in the $2 to $3 million range, whether we're talking to a developer and whatever in the residential department, can I say that across the real estate landscape broadly, the pandemic was an interrupter, not a game changer. And in just almost every area, it's now clearly emerging, and wasn't a surprise to me that most things have not changed. And so what you were good at in real estate, or what you aspired to in real estate before the pandemic, don't feel you have to change all your opinions and go and buy a new set of tools and develop a new intellect. What you aspired to and what you were equipped to do in the real estate market remains just as relevant post-pandemic as it did before, okay? Now, during the commentary, you heard people saying, oh, the market's fallen by 30%, 20%. All these single figures are ridiculous. The real estate market, the residential market's made up of so many different components: inner urban, middle urban, outer urban, established housing, townhouses, apartments, house and land, one thing and another. A couple of things. If you're asking, is there going to be continued growth at the current rate that we've seen over the last couple of years, which was a surprise to most people, the answer is, for most of the market, we will not see this continued rate of growth. It will slow down throughout 2022 and a bit more in 2023. It won't go down in real terms. The rate of growth will slow. And if there is any risk at all of unexpectedly higher interest rates, which there shouldn't be because there'll be gradual returns, but when we take off the financial bandages from the pandemic, we'll find that a lot of the sores we've got are still there, because the pandemic, just disguised the ills of the Australian economy to some degree. There's still a lot of tough challenges in this economy. If any homeowners are at risk, they're the ones with very high mortgages, two mum and dad both working, 3 kids, 4 cars, miles and miles away from town. The ones that are just on the very edge of home ownership, like all economic circumstances, are the ones most likely to feel hardship if the economic conditions change. If you want some figures that are meaningful, particularly to the group that are listening, probably in Melbourne, once you get over $1 million of real estate value, you're on the right side of what I call the safety zone. Over about $1 million, there's not a real risk that all of the makeup that supports that and all the fundamentals that support that and the participants in that market, there's not a real risk of a fall there that I can see given future economic conditions. Because even if there was about to be a fall, there's a lot of people that are just marginally outside of that purchase capacity that would rush in and catch the market before it fell any further. If you move ahead to, whereas I hope, say, most of our listeners this evening, if they own a home, they're probably in the somewhere in the $2 to $5 million bracket if they live in inner urban Melbourne and one thing or another. That's a great place to be, and you will see continued growth there, and you shouldn't be reluctant to roll the dice again, capitalise on extensions and one thing and another. This is probably not relevant to our listeners, but if you are in the prestige market, which in Sydney is $15 million plus and in Melbourne $10 million plus, that market is about to become completely detached from all of the other market fundamentals and rush ahead so quickly with sustained capital gain over the next 5 years that we'll all be blitzed by the speed with which it moves, because there is so much wealth being created in this community. And both in Melbourne and Sydney, in terms of prestige property, there's very little of it. Melbourne and Sydney grew up in response to the needs of working and lower middle class people. There were very few rich people in the early history of both of these relatively young cities. And we have always been undersupplied with really expensive, good real estate. In Melbourne, it was just Toorak Hill and around the Yarra River here and there. And in Sydney, it was just on a few peninsulas around the harbour. It's a very rare commodity, and increasingly there are more and more people that can afford to buy it. And we just did a research paper, which is coming out next week, that talks about the top 20 sectors of business that boomed during the pandemic. And not surprisingly, they're all private sector related. And there are so many people just out of the last couple of years that can now afford to spend $10, $15, $20 million on a property that they'll just keep motivating that market. But Scott,
I've got to cut it in there because the rabbi has told me sharp close at 6 o'clock.
Okay.
So, but maybe you can make that research paper available to YJP. And they can distribute it for those who are interested in it. I've read a lot of your research papers and they're all fantastic. Rabbi, we're going to have to do a follow-up because you can see we're only warming up here. And I've got so many questions I want to ask our panelists. I've got one last one for Tracy, and then we'll close it up. Tracy, and a few questions coming through on the chat, which we're not going to get to, but one sort of touches on asset allocation. given where the world's at, how much cash should one hold in one's portfolio? If you've got $100,000, you know, what percentage should you hold in cash?
Well, I think it obviously it depends on your age. For young people, I would suggest very little, because you are, 25, 30 years old, you've got 30 or 40 years of working ahead of you. So you're not getting paid to go into cash. So I would say as the bare minimum as you can possibly afford to put into cash. And I would be going for the alternatives, the private debts, the private equities, the really interesting stuff around clean energy and technology disruption. These are fascinating areas, and this stuff is only just starting to get going in our view. Fantastic.
One last sentence from each of you, and then I'm handing it back to the rabbi. Closing word of wisdom for our listeners. We'll stay with you, Tracy.
I guess my advice would be a sponge. I'm fortunate with every single person that I've worked with over the years. I've learned something from, and I've remembered it. And I am the person and the employee that I am today because I've remembered everything that I've learned. And there's a lot of really good information that you can learn from the people that you're working for right now. So be a sponge.
Great. Anita?
Probably a little bit along the same line, collaboration is key. So, build those relationships and learn to collaborate, even though you might be the smartest in the room.
Scott?
Oh, very simple, Farrell. Pursue home ownership. Don't worry about too much debt in these low levels. If you're a professional person with a reasonably secure income future, roll the dice. If it gets too much, you can always sell it.
Fantastic. And before I hand over to the rabbi, I'll tell you what mine is, which is not really mine. It's Rabbi Sachs, and who I often talk about and quote. He's got many wonderful lines, but the line that I love most is focus on things greater than yourself, and you'll become greater than yourself. Rabbi, over to you.
I'm going to pass on to Rabbi Yossi, who's going to close. Yossi.
Farrell, and thank you to all of our presenters for presenting today. As someone who's young, Jewish, and professional, I have learned a lot from everyone here tonight. Tracy, Anita, and Scott, both the advice around where the economy's at and advice around career and developing yourself and what makes a good employee. So thank you so much for sharing of your experience and expertise with people like myself and the audience here today. Before we log off, I just want to let everyone know about what's happening between now and the end of the year at YJP. Because we're now back in person, we are capitalizing on that over the next couple of weeks with lots of social events coming up this Friday night, Hanukkah, etc. I encourage you to take a look on our website or Facebook page, so yjp.org.au/events, and you'll see everything that's happening there. And there's something for everyone. And we look forward to welcoming you there.
Anita and Tracy and Scott, thank you very much. You guys have been wonderful. We'll do it again.
Thank you very much, Farrell, and good evening, everybody.
Thanks, Farrell.
Thank you to all of you. Really, thank you. Incredible workshop. And that can really thank you, Scott, Tracy, Farrell, Anita. Really incredible beyond. So informative. Anita, I really want to get that list of 10 names. And I don't know if Farrell was joking, but I think it was brilliant. What makes an employee a good employee,
I'll send them to Farrell.
Please, because they were incredible. Yes. Thank you to all of you. Thank you.
Thanks, guys.
Good night. See ya.
Bye.
Thank you.